There are two funds. If I have to look at some data that we've got from Morningstar, there are two funds that are really standing out with more than 5% of returns so far this year. One is a floating rate fund, 5.8%, and the other is the credit risk fund. So let's start talking about the floating rate fund, which seems to be giving more stable returns compared to credit risk funds, because even the bottom performer has managed to eke out, of course, a very small gain, but nevertheless a 2.5% return. So to start with, tell us, what exactly is a floating rate fund?
Okay. You're absolutely on the point out there that floating rate and credit risk funds have actually done very well for this year also. Now, floaters as an instrument is something which is linked to interest rates directly. So if your interest rates are likely to go up, floating rate will reset its interest rates basically. So the coupon in the floating rate instruments keep getting reset as per the interest rate movements technically. As per SEBI definition, 65% of the total assets of a floating rate fund are to be invested into floating rate instruments necessarily, which means 65% of your portfolio will keep getting repriced. It can get underpriced also if interest rates go down. It can get overpriced also, or it can get higher coupons if interest rates go up basically, right? But the problem in India is that you don't have actually real class floaters available, or so many floaters available in the market. There are around, if I'm not wrong, there are around 12 floating rate funds in the country with an aggregate AUM of almost around 85,000 odd crores, right? So the market is fairly high. The category has been witnessing net positive flows of late because investor interest is fairly high because it's been receiving positive flows, and the returns are also fairly handsome in the category.